The world of cryptocurrency presents two distinct paths for participation trading investing. Many newcomers often believe these are one and the same, a simple route to quick riches. This is a common and dangerous myth. In reality, they are fundamentally different approaches, strategy, mindset, set of skills. Crypto trading is a fast-paced activity focused on profiting from short-term price fluctuations. It is a game of speed, technical precision, constant market vigilance. It requires you to be active, often daily, making decisions based on charts, immediate market sentiment. In stark contrast, crypto investing is a long-term commitment. It is the act of buying and holding digital assets, belief that their fundamental value will increase significantly over months or even years. Investors are less concerned with the daily noise of market volatility. Underlying technology. Potential for widespread adoption. Investing is a marathon, not a sprint. It demands patience, thorough research into the project's core principles, emotional fortitude to withstand downturns. This essay will explore the vital differences between these two disciplines using a myth versus math approach. We will challenge the popular misconceptions that often lead to financial loss. For instance, the myth that trading is an easy way to make money will be countered by the mathematical reality that most unprepared traders fail. We will delve into the practical distinctions, such as time horizons, involved goals. Each path aims to achieve specific tools used to make informed decisions. The aim is to provide a clear, calm, and steady guide to help you understand which path aligns with your personal goals and resources. Ultimately, there is no single winner that suits everyone. The right choice depends entirely on you. It depends on your available time tolerance for risk level of expertise, financial objectives. By understanding the core mechanics of both, crypto trading is the art and science of capitalizing on short-term price movements. Traders operate on tight schedules, with timeframes ranging from a few minutes to a few days. Their primary objective is to generate consistent, albeit smaller, profits by buying low and selling higher within a short period. Traders might execute dozens of trades in a single week or even a single day. They are not focused on a project's 10-year roadmap. Their focus is almost exclusively on price action right now. Traders rely heavily on technical analysis, studying charts to spot patterns, studying charts to spot trends, studying charts for potential future movements. Tools include candlestick patterns, with moving averages and RSI visible, volume indicators showing trade strength, RSI signaling overbought or oversold conditions. These provide clues for entry or exit points. The trader's world is visual: lines, graphs, data streams. Trading demands significant time and unwavering focus. It is not passive. Successful traders spend hours each day monitoring charts, staying on top of breaking news and managing open positions. A single tweet or a regulatory announcement can move markets instantly, so traders must react immediately. Crypto investing operates on a completely different philosophy and timescale. An investor is akin to a digital farmer, planting seeds in projects they believe will grow into robust and valuable assets. Their time frame is not measured in minutes or days, but in months, years, or even decades. They buy and hold, often called hodling. Despite short-term volatility and market crashes, the fundamental value and utility of chosen assets can lead to substantial long-term growth. The investor's toolkit differs from a trader's. Instead of price charts, investors do deep fundamental analysis. They investigate the project itself, read the white paper, scrutinize the team's background and track record, analyze the tokenomics, how the coin is created, distributed, and managed. Goal: find projects with strong foundations and real-world adoption potential. Patience is the investor's greatest virtue. Markets move in cycles. Negative price action is part of the journey. A trader may see a drop and sell. An investor may see it as a chance to buy the dip. Risk is an inherent part of the cryptocurrency market, but it manifests differently for traders and investors. For traders, the risks are immediate and often amplified. The high frequency of trades means that even small mistakes can quickly compound into significant losses. The allure of leverage, borrowing funds to increase the size of a trade, is a double-edged sword. While it can magnify profits, it can just as easily magnify losses, potentially wiping out an entire trading account in a single bad trade. The speed of the market means there is little room for error, making disciplined risk management absolutely critical for survival. A pervasive myth is that trading is a form of gambling. While reckless trading is indeed gambling, disciplined trading is about managing probabilities. The math shows that successful traders have a strict rule: never risk more than a small percentage, often 1 to 2% of your capital on a single trade. They use stop-loss orders, an automated instruction to sell an asset if it drops to a certain price, to cap their potential losses. This mathematical, rule-based approach is what separates professional traders from gamblers who rely on hope. For investors, the risks are more strategic and long-term. The primary risk is not daily volatility, but the possibility that a chosen project may fail to achieve its goals, lose its relevance, be overtaken by a competitor. A project could suffer from a critical bug, a failure in leadership, an inability to gain traction and user adoption.